All right, if you need a fast, hard-hitting revision on how we think about investment risk, you are in exactly the right place. We are going to boil down decades of dense financial theory into one quick, clear summary. Welcome to The Explainer. It's the age-old question, isn't it? How do you balance risk and reward? For decades, the smartest minds in finance have been trying to find the secret formula. Today, we're going to walk through that entire story, from start to finish. It's the perfect last-minute refresher on the ideas that shape basically all of modern investing. So here's our game plan. We're going to start at the very beginning, when risk was just a gut feeling. Then we'll get into the famous efficient frontier, see how the CAPM model tried to simplify everything, and then look at what came after. And of course, we'll wrap it all up with the absolute key things you have to remember. Let's do it. Okay, let's rewind the clock. Before the 1950s, investing was, well, it was mostly just an art form. You know the old saying, don't put all your eggs in one basket? That was pretty much the extent of risk management. It was all intuition, not math. And then boom, Harry Markowitz comes along and just changes the entire game. He had this radical idea that risk wasn't just some fuzzy, scary concept. He said we can actually measure it. We can put a number on it, using things like variance and standard deviation. And just like that, portfolio theory started its journey from being art to becoming a science. Now here's the real kicker. The genius of what Markowitz did wasn't just saying, hey, buy a bunch of different stocks. No, he proved mathematically that the real magic, the secret sauce, is correlation. It's about owning things that zig when other things zag. That was the breakthrough. And so, all of this groundbreaking work got a name: Modern Portfolio Theory, or MPT for short. And this wasn't just a cool idea. It gave us a whole new toolkit for actually building smarter portfolios, for organizing that basket of eggs. So what's the big idea here? MPT basically says that for any level of risk you are willing to take, there is one and only one portfolio that gives you the absolute best possible return. It's all about getting paid the most for the risk you're taking on. Think of it like a map. First, you have the opportunity set. That's literally every possible portfolio combination you could dream up. Then, MPT draws a line through only the best options. That line is the famous efficient frontier. And on that frontier, there's one special spot, the GMVP, which is the portfolio with the least possible risk you can build. Okay, so MPT sounds incredible, right? But it had a huge real-world problem. It was ridiculously complex. To build that efficient frontier, you had to calculate how every single stock correlated with every other single stock. I mean, just imagine the spreadsheets. That complexity really paved the way for the next big idea. And that next idea came from William Sharpe. He came along and asked a brilliantly simple question. He said, what if the main risk isn't about each individual stock, but about how that stock moves with the entire market? And that simple idea led to the capital asset pricing model. You know it as CAPM. And CAPM boils all of that MPT complexity down to one beautiful, simple number: beta. I love this analogy. Think of the whole market as a shopping cart, and your stocks are the eggs inside. Beta just tells you how much your eggs jiggle when the whole cart hits a bump. A beta of 1 means they jiggle right along with the cart. Simple as that. And this elegant idea gives us some really powerful rules to live by. The biggest one is this: the market does not reward you for taking on risks you could have easily diversified away. So, a single company having a bad CEO, that's your problem. You only get compensated for taking on the risk of the whole market going down. That's systematic risk you can't escape. But, and you knew there was a but, CAPM is a bit too perfect. For that beautiful simplicity to work, it has to assume a world with no taxes, no transaction fees, and that everyone has the exact same information. And you and I both know that's not the world we live in. That gap between theory and reality created the need for the next step. So this led people to ask, okay, what if the cart hitting a bump isn't the only risk that matters? What about the economy, or inflation, or interest rates? You know, the weather and the road conditions. This thinking is the bedrock of what we call multi-factor models. This is the big leap forward. CAPM is laser-focused on just one risk: the market. Multi-factor models say, hold on, other big-picture things are also systematic risks you can't avoid. Things like a surprise jump in inflation or a slowdown in GDP. Those things affect everything, and they should be priced into assets too. You can really see the upgrade here. Instead of one beta, you now have a bunch of them, one for each risk factor. And the definition of bad times gets a lot richer. It's not just the market falling, it's also a recession or high inflation. The core idea is that there are multiple systematic risks out there, and you get paid for your exposure to all of them. Okay, we just flew through decades of financial innovation. Let's lock this all in. If you're studying for a test, this is the part where you really lean in. You can see the whole story arc, right? MPT gave us the science. It let us quantify risk. CAPM came along and made it beautifully simple with a single number. Then, multi-factor models brought back the real-world messiness, but in a smart, organized way. Each one really built on the last. So here's your final checklist. 1. MPT is all about correlation. 2. CAPM says you only get paid for market risk. 3. Multi-factor models say you're exposed to many systematic risks. And kind of floating around all of this is the idea of efficient markets, the theory that all this stuff is already baked into the price, which makes finding an edge pretty darn hard. And this quote right here, this just nails it. This is the modern way of thinking. You're not just buying a company, you're buying a bundle of exposures to things like economic growth, inflation, and market momentum. Understanding that shift is everything. So this whole journey shows that our understanding of risk is never really finished. It keeps getting better, more refined. Which leaves us with one final thought to chew on. As our models get more and more complex and closer to reality, are we actually getting closer to a perfect formula for investing? Or are we just getting better at understanding why one might not exist at all?